Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. The show today is brought to you by Bull Realty. You recognize the name? Yes, it's my company. We're commercial brokers. We work in the Southeast U.S. So if you want to sell office, industrial, land, retail, hotel, we have groups in every specialty. Or if you're a lender or a borrower, we have special skills in that area that we can help you with. All right, let's get to the show. You know, there's a lot of questions from some folks in the commercial real estate industry where we are. You know, here we are in April of 2025, and we have this tariff unrest happening, right? We have tariffs. Do we not have tariffs? Yeah. What's going on there, and how's it going to affect tenants? How's it going to affect capital markets? One of the groups of ownership groups that everyone thinks about in commercial real estate are REITs, right? REITs own a lot of great real estate, especially around the U.S. Please welcome my guest. It's David Auerbach. He's Chief Investment Officer with Hoya Capital. David, good to see you. Thanks for being in Studio One.
Michael, thanks for having me. It's great to be here.
Well, thank you. And so, you know, with what's going on in the real estate market and what the volatility we've had in the stock market, how is that impacting REITs? How are REITs performing, you know, on the market, and how are their earnings actually performing?
Well, first of all, volatility equals opportunity, right?
Mm-hmm.
With a lot of these REITs, frankly, they're trading at deep discounts. They're trading in lockstep with the broader market. REITs used to be the hedge to the market. You know, if the Dow is up, the REITs are down. And if the Dow is down, the REITs are up. Well, now everything trades in lockstep. But here we are a couple of weeks later after tariff announcements and talking to REIT executives, what they'll tell you is, look, our earnings haven't changed, our dividend hasn't changed, but my stock price is down 20, 30, 40%. What gives? Mm-hmm. So for a lot of these guys, their earnings have been holding up. A couple of the lodging sector REITs players have reduced their guidance for 25, kind of being a little bit proactive in case there is a slowdown in travel. But for a lot of these companies, it's business as usual. They're growing their revenues, they're growing their net income, they're growing their dividends. You know, they're taking some more cautious tone because a word that getting kicked around all of real estate is uncertainty. Mm-hmm. You know, the only thing that's uncertain is uncertainty right now. Until we know what that number is, how much lumber is going to be impacted, how much that tariff is going to be. A lot of folks are just operating as business as usual. They're leasing, they're renting, they're buying, they're selling. Life goes on.
So their earnings has really been so far really strong for the most part, right?
I would say that most of the guys have met expectations. A handful have exceeded expectations. A handful of guys have missed expectations. It's almost like your classic bell curve. Mm-hmm. As I like to say, you know, your graduating class of high school had 300 kids. Mm-hmm. You had your top 10%, the valedictorians. Mm-hmm. You had your troublemakers, the guys that were in detention every single day. And then you had everybody else in the middle. Mm-hmm. Well, replace the word graduating class with REITs. Mm-hmm. You've got 200 publicly traded REITs. You've got your best in breed dividend champions, S&P 500 stalwarts. You've got your troublemakers that are over-levered, cut their dividends, going through issues, and then everybody else. We like to focus on the everybody else because that's kind of the unloved part of the market that really doesn't get a lot of that attention.
Yeah. And on these earnings calls these REITs have had recently, are some of them saying, hey, this is what we expect for a forecast if tariffs are worse, and this is what our earnings forecast is otherwise?
They're putting in some cautious language. Nobody has come out like a United Airlines yet that has said, if there's tariffs, our guidance this year is going to be X. If there's no tariffs, our guidance will be Y. Most of these guys are basically saying, we need to learn more. When we learn more, we'll make sure to tell you guys how it's going to impact us. Like I said, the only sector that's really started pricing that in is really the lodging guys. And it's a dual reason. It's not because of the tariffs necessarily. It's because of the international inbound slowdown of travelers because let's say it's America off right now. But the other side of that's Doge. Doge has impacted group travel business, conferences. So if you're hosting a government-based conference in Washington, D.C. or Southern California, as an example, some of those properties are seeing cancellations from these group events. But you're still going to go take the kids to see grandma and grandpa. You're just not going to stay at the Peninsula. You'll probably stay at the roadside, Marriott Hotel or the Courtyard by Marriott instead.
Yeah, good point. David, when you look at the debt situation for REITs and you trend it to what their debt load would have been, say, in the last recession or before the last recession, or you compare it to private ownership property, what do you see there?
That's a great question. And this is probably one of the biggest misconceptions about REITs, as we've heard so many years about this commercial real estate wall of debt that's coming due. Oh my gosh, the sky is falling for commercial real estate because there's just so much debt. Remember that REITs are only a tiny segment of the world of commercial real estate. And as I talk with advisors and investors and everybody in between, I always emphasize, you got to peel back the layers of the onion, get to the company level and understand what's going on. At the REIT level, there is not a wall of debt that's coming due. They have extended debt maturities. They've got it well laddered out. In this week alone, we've seen 3 debt deals raising close to $2 billion by the publicly traded REITs. For the publicly traded guys, the debt window is open. You can go out and get 5-year paper, 10-year paper, 25-year paper. To answer your other question about versus the previous recession, this goes back about 25 years. And if you go back 25 years ago, when many of these REITs were over-levered, that's kind of what led to the crisis in 08, 09, 13, 14 on the housing side of things, when that led to the birth of the single-family rental population, et cetera. You know, a lot of these REITs got the message. And so now they have sub 50% leverage ratios, meaning they could bump it up a little bit more, but is that the best use of that, proceed? Would I rather go out and buy back my stock instead? Would I rather go out and issue forward equity or an ATM at the market equity offering? Because we're not seeing REITs really do secondary offerings right now, but the lending side of it is wide open.
Yeah. So if REITs are buying their own stock, is that a message probably maybe for investors that could be a good time to buy REITs while there's market volatility and some people think real estate sky's falling?
It's usually a bullish indicator if you see management buying their own shares, or the companies buying their own shares. It's very important for investors to understand that the largest institutions, that own hundreds of thousands, if not millions of shares, are always buying and selling. But here's the thing with REITs right now. If you compare the REITs versus the S&P 500, REITs are underperforming the S&P by about 35 to 40%. That's unprecedented. Something has to give. Either the S&P has to sell off, the REITs have to rally, or some combination of both. But what hasn't changed, again, is most of these REITs have been growing their annual dividends. Most of them have been raising new capital as warranted. And so, again, when you look at the REIT sector, you got to take it with a 25 to 50-year lens. We have no control over our stock prices. We run 2 ETFs on the New York Stock Exchange. We manage about $120 million across 2 ETFs. I've got no control over my stock price. I have no control over my constituent stock price, all the companies that make up our fund. What we control is the message, the narrative, the why REITs and commercial real estate belong in the portfolio. And I think a lot of these companies will tell you the exact same thing. This is why this sector should be in your portfolio. We're an office REIT. We have a 25-year, average lease term, let's say, or a 10-year average lease term. We, the office landlord, are not susceptible to tariffs. If we're developing new office and the cost of lumber goes up because of tariffs, that's one thing. But running an existing office building like we're sitting in right now is not impacted by tariffs. It's your tenants that might be impacted by what's going on at the tariff level. But for a lot of these companies, again, going back many years, the job of management teams is to put the blinders on, focus on fundamentals. With REITs, it's how do I grow my revenues, minimize my expense growth to maximize my net income, to push out the most dividend possible to my shareholders that I can. And with REITs, remember, it's dividend income machines. So when management teams who own a lot of stock see their dividend go up by 10%, guess what? Their quarterly bonus just went up by 10% because they own all of the stock. Unlike a lot of the other sectors, I think REITs are one of those sectors where management is as entrenched or in the trenches with their shareholders than any other sector on Wall Street. So they are not just basically saying, trust us, we know what we're doing. It's we're riding this out with you guys, and we're putting our money where our mouth is because we believe in this thesis, this company, this sector, this industry, this market, whatever it is. They're riding the front line with the starting offense.
Yeah. Well, good point. What about dry powder? How much do these REITs have to invest now? And do some of them that you talk to and study, do some of them look at this as a buying opportunity in 2025?
Absolutely. There is a lot of dry powder. As we were talking earlier, I think a lot of these companies right now are really kind of staying inside the box. We're looking at deals right and left. With every day that passes, our existing real estate gets that much more valuable. That person gets much more distressed because they're not seeing this exit strategy. So we're getting inbound phone calls more and more. But we're not going to buy something at a 6 cap when our minimum handle is a 7 cap. We are literally going to put the gate down and say, until the seller comes to us with a 7 handle, we are not interested. But we're there. We're at 6.5. We're not budging. And I think that's the key with this dry powder. We'll put it to use if the numbers work. But the problem that you're seeing, again, is because some of these REITs are trading at discounts to NAV, the cost of capital is a little bit more expensive because their equity isn't as valuable as it would have been a couple of years ago or pre-COVID, let's say. And that's the funny thing about REITs. You could take a version of pre-COVID, post-COVID. Why I mention this is pre-COVID, the REITs were at an all-time high. Performance was firing at all cylinders. It was like shooting fish in a barrel. Everybody was doing phenomenal. COVID hits, boom, we hit this wall, we come to a pause. Here we are now several years past COVID, okay? The REITs themselves are putting up numbers that were blowing away what they were doing at the peak pre-COVID. But the stock prices are still trading at a 30-40% discount, and the dividends still haven't even caught up to where they were pre-COVID as well, because a lot of these companies are being more conservative. Do we want to pay out an extra 5 cents a share to our shareholders, or do we want to retain that cash for a rainy day or find that right opportunity that presents itself in a volatile time? This is the stuff that management teams are focusing on every single day.
Yeah. David, what would be your tip for sponsors, developers, and other folks that want to reach out and do business with REITs?
Pick up the phone and call them. Ask the question. The worst thing that the company will tell you is, thanks, but no thanks.
Yeah.
Thanks, we're not interested. But if some of these REITs are able to find opportunities working with local sharpshooters, and that's the key, it's the local sharpshooter angle. We know this market better than you guys know it. We've been in this market for 50 years. You guys have been here for 5 years. We know where all the bodies are buried, let's say.
Yeah.
So as a result, if these REITs are able to partner with the best-in-class operators in their local markets and acquire assets off market that are not being shown by 10 different brokers on a nationwide basis, they're looking at these deals. They want to partner. I think the other key or the other side of the coin is, what's the capital needs? Who is expected to bring what to the table? The REITs will bring obviously, if you're a large cap REIT, you really don't need the local guys. But I mean, again, if for the right opportunity presents itself, they're going to look at it. For some of the smaller players, if they partner with a local capital source, or again, the right family office, the right institutional investor, it's not about the deal we're doing today. It's this partnership that we form that we're going to be growing over 5-10 years together. That's where a lot of these REITs could be excited, because how do you go from 10 properties to 100 properties? You could sit there and buy one-offs, or you can buy portfolios of deals with partners and eventually take out your partners as things continue to improve. And now you've got a rocket ship that you're just growing that portfolio base.
What do you think about REITs involved in debt and buying debt or providing debt?
It's obviously a much different universe in the world of the equity REITs. It definitely goes through a much more stringent process. The let's say rules, regulation, compliance microscope is much more laser focused. Mortgage REITs, lending REITs are much different in 2025 than they were pre-COVID, frankly. And so just out of personal experience, I would just, again, do your own due diligence. I'm a little tiny biased personally. I've always thought if you're going to tiptoe in that space, play with the big boys. Blackstone, Starwood, Annaly, Colony, again, the biggest players that are out there, especially a guy like Blackstone. Blackstone could be either the last man standing when it comes to the world of commercial real estate,
Mhm.
or they're going to sink our whole industry. And when people are like, "Oh my gosh, what does Blackstone know?" I always like to say, "You're going to bet against Steve Schwartzman and John Gray. You're going to bet against Barry Sternlicht.
Mhm.
Good luck."
Yeah.
So, again, I would just do your due diligence,
Mhm.
partner with the best in class, but it's a completely different universe than your typical bread and butter equity REIT.
Yeah. So when you look and you talk to these REITs a lot and you study them, and so you think that some of them kind of look at this as a buying opportunity. It seems to me when I've been in this business for a long time and been seeing a lot of downturns, and it seems like it's the groups that do a lot of acquisitions in tough times that really create fortunes. And when I look at 2025, I predict, and I guess people can listen to the show in the future and go, "Michael, you were wrong." But
I hope we're right, but yeah, go ahead.
I predict that office is the buy of the century, or decade. I mean, and certainly I think the buy of 2025 because of the lack of new supply. And it seems like that with a lot of property types that new supply has been hitting because they were underway. But it seems even when we look at multifamily that maybe there's a lot of new supply still hitting now, but that's about to end because of the higher rates and construction costs. That there's going to be very little new supply. Are the REITs kind of looking at that like, ooh, buy now because rents are going to go up in 26, 7, and 8?
It's actually both the REIT level and the investor level.
Mm-hmm.
We kick around this term called generational wealth creation opportunities. And when you're able to buy some of these REITs at deep discounts, you're able to buy some preferred stocks of quality companies with 7, 8, 9, 10% yields of guys that are going to be here 25, 50 years from now.
Mm-hmm.
That's opportunity. We talk about how many malls are being developed across the country right now. I can't think of a mall that's under development. How many real Class A office buildings are being developed coast to coast right now in office? I'm not guessing that very many.
Not enough.
Housing. How many houses are being built right now to satisfy the 5 to 6 million folks that want to buy a house or buy that first time house? Not enough. This is where
apartments.
And again, oh my gosh, apartments were overbuilt. Are we? In some markets, yeah. But again, think about how population trends and migration trends shift. If you look at COVID as the perfect example,
Mm-hmm.
everybody left New York in droves. Oh my gosh, we can't rent an apartment in New York. Everybody left. New York is one of the hottest rental markets in the country right now. You can't even rent an apartment in New York.
Mm-hmm.
Chicago, Milwaukee. These are places where people are like, who wants to rent in Chicago, Milwaukee? Spartanburg, South Carolina. Some of these places, again, it's not where the puck is, it's where the puck is going. So, we always get asked the question, what's the next Nashville? What's the next Raleigh? What's the next Austin?
Mm-hmm.
We don't know the answer to that. My personal gut on this, it's going to be like an Omaha. It's going to be a Milwaukee. It's going to be something kind of central in the country, 2.5 hours each way, coast to coast.
Mm-hmm.
But it's going to lead to development opportunities. And thinking about how these REITs operate, it's not where we're planting our flag today. It's where's that flag going to be planted 10 years from now? Who's going to be the first to go and develop in Omaha because they see the signs of commercial real estate trending towards Omaha?
Mm-hmm.
Who is going to pony up to convert that Class C office property in Kansas City to be a resi conversion because this is the most desirable asset in this market and it's historic landmark. This is not going away, but we need to repurpose it so that the next 100 years worth of users can enjoy this property like we have for so many years. Yeah. This is where REITs get excited because this is where opportunity comes. Yeah. It's how are we going to shape the page for the next future generation of leaders by what we're able to do today. Yeah. Great example is Disney. Again, Disney just announced this huge project in Abu Dhabi today, and they got asked the question, when's this going to even open up? And they go 5 to 10 years down the road. But they're announcing it today because, again, it's where is this going 5 to 10 years from now? Yeah. You think Abu Dhabi is going away 5 to 10 years from now? No, it's going to be even larger than it is today. Yeah. Is Atlanta going away? No, it's going to be even larger. It's just going to be much more spread out. Yeah. I like to joke, because I'm from Dallas, that it's just a matter of time until Oklahoma City and Dallas, it's going to be strip centers and housing all the way up on 35 going straight up north. It's just a matter of time until it all fills in.
Yeah, It's crazy to think about it that way. And yeah, I like it. It's I'm seeing the deals right now, and I look historically at this industry, and like we have some projects out at 20 million, 24 million, 40 million that some of them you can get for an 8 cap yield, and the prices per square foot are in some cases 20 to 30% of replacement cost. It's like, how do you go wrong? And they're fully occupied with long leases with high credit tenants. It's like it does seem like the time to buy right now for those with the fortitude and the ability. Of course, REITs have the knowledge and the ability.
Well, again, you look at sovereign wealth funds. When the sovereign
Mhm.
wealth fund buys a property, it's not what's going to do next year. It's I'm buying this for the next 25 to 50 years.
Mhm.
So again, if I can own the premier asset in the premier market at the intersection of Main and Main that
Mhm.
every single person knows for 30, 40 cents on the dollar,
Mhm.
wait, who's the sucker here? The seller, or am I the sucker because I'm walking into something here? And
Yeah.
again, most of the time it's the market is dictated. This is an opportunity. So
Yeah.
I do think with some of these REITs, you're going to, and again, we're hearing it from the REITs that the phones are ringing more and more. Sellers are trying to get, work with these companies, sell some of these assets.
Mhm.
Look at Blackstone and how active they are across
Mhm.
all the different sectors that they're involved with. We're not going away. We're just going to continue to keep growing at our little pace that we do. Real
Yeah.
estate's boring, man, and boring is good.
That's right. It's time to buy in my mind, but that could be coming from a broker who sells properties. But when I look historically, it sure seems it like that. Well, David, how can the listeners and viewers reach out to you or get more information from you guys?
Sure, thanks. I'm very accessible. I'm very approachable on social media. You can find me on LinkedIn. You can find me on Twitter, the Daily REIT Beat. I publish a daily newsletter that covers the REIT industry.
Mhm.
We manage 2 real estate ETFs at Hoya Capital, hoyacapital.com.
Mhm.
Both our website, our Seeking Alpha research platform at Hoya Capital. But if they want to contact me, david.auerbach at hoyacapital.com. We're always here to educate about the world of REITs.
Awesome, David. Thank you for joining us.
Thanks
Great
for having me. I
information.
really appreciate it.
All right. And thanks for joining us around the country. Hey, let me know what you think. Is it time to buy? Is it time to sell? I guess it depends on the property, the lease, your debt, and your plans. But I think it's a great time to be out there buying property. Tell us what you think. Hey, appreciate you sharing the show. If you appreciate the information you get here, can you pay it forward and share it with some other folks? We appreciate it. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.